Hi everyone, Demir here from Westmount Wealth Management. Let me start with a very simple question. If I handed you someone's investment statement, would you know how risky their life actually is? Probably not, because traditional portfolio construction typically looks at assets in isolation, stocks, bonds, alternatives. You optimize that mix, you run the numbers, print a pie chart, and you're good to go. It assumes investors show up as blank slates, but nobody's a blank slate. People show up with careers, business interests, stock ownership, options, pensions, real estate, deferred compensation, and so on. In other words, they show up with risk already baked in. Building a portfolio without accounting for that is like designing a house without checking the foundation. The paint might look great, but that's not where the real structure lives. So let's talk about the asset most people never see on a statement. It's human capital. Your future earning power is often the largest asset you own, especially early in life. And it behaves just like any other financial asset. It's a stream of future cash flows. The key question is pretty simple. How stable are those cash flows? If you're a government employee or a tenured professor, your income is relatively stable. That's bond-like human capital. If you're an entrepreneur, on the other hand, you're a commission-based professional or a business owner, your income rises and falls with the economy. That's very much equity-like human capital. And here's where it gets rather interesting. If your paycheck behaves like a stock and your portfolio behaves like a stock, you may not be as diversified as you think you are. You may just be doubling down. It's like owning a boat company and then investing your portfolio entirely in boat manufacturers. It works beautifully when the water is pretty calm, but it goes rather wrong when a hurricane rolls in. Research in financial economics is very clear on this. When labor income is volatile and correlated with markets, optimal portfolios should typically take less financial risk, not more. Ignoring human capital doesn't simplify planning, it actually distorts it. Here's another thing that changes quietly over time. It's your risk capacity. Early in life, your future earnings dominate your balance sheet. You have decades of income ahead of you. Market volatility is uncomfortable, but it's very much survivable. However, as you age, that flips. Human capital declines, financial capital becomes the main engine of your security, and a portfolio that might have made sense for you at age 35 may not make sense at all at age 65. The ability to recover from losses changes, the math changes, and the consequences definitely change. It's the difference between falling off a bike when you're 12 versus falling off a ladder at age 70. Both are pretty painful, but likely they have very different outcomes. Now, let's talk about held away assets. Private businesses, employer stocks, real estate, defined benefit pensions, deferred employee compensation. These often sit outside the portfolio that gets optimized, but they materially shape total exposure to risk. You can have a well-balanced looking investment account and still be heavily exposed to equity risk through a private business, for example. Or perhaps the opposite. You are lucky to have a defined benefit pension, which behaves a lot like a bond, in that it provides you stable retirement income. And that may justify taking on more growth exposure or equity risk elsewhere. Ignoring held away assets is like looking at one piece of a puzzle and declaring that the picture is complete. On paper, everything might look diversified, but in reality, risk may be quietly rather concentrated. This is where completion portfolios come in. A completion portfolio doesn't ask, what should this account own? It asks, given everything you already own, what am I missing here? Two investors with identical brokerage accounts may require completely different allocations once you account for their careers, pensions, businesses, and liquidity constraints. Diversification is not just about owning, different securities. It's about balancing different sources of economic risk. True diversification often happens outside of, the portfolio pie chart. Let's be real. How many Canadian real estate investors are now second-guessing those real estate-heavy portfolios? Diversification seems to only matter to some in hindsight. Cookie-cutter model portfolios assume investors are rather interchangeable. Same age, same risk bucket, same allocation. But optimal asset allocation depends on labor income risk, correlations, life cycle stage, and liquidity needs. Failure here is rarely dramatic. It doesn't explode overnight. It shows up during periods of stress. A market decline can hit at the same time as your income drops. Liquidity is needed from assets that were perhaps never meant to be sold, and often correlation spikes during bad times. It feels like bad luck, but more often than not, it's incomplete design. Personalization is not complexity for complexity's sake, it's engineering. And good engineering starts with the understanding of the full structure. To summarize, two investors can hold the same portfolio and experience very different net worth outcomes. Because wealth is not just a number on a statement, it is the relationship between income, obligations, flexibility, and behavior. At Westbound Wealth Management, we don't build portfolios in isolation. Where appropriate, we build completion portfolios designed around lives, not templates. True diversification begins by asking a very simple question. What is your risk already hiding? And sometimes the most important asset that you own is not your account at all, but it's your human capital or your held away assets. Thanks for watching. And as always, if you have questions, you know where to find us.